The material shown in this presentation is general information only, so please do not take this as personal advice. Okay, acknowledgement of country. The University of Queensland acknowledges the traditional owners and their custodianship of the lands on which we meet. We pay our respects to their ancestors and their descendants who continue cultural and spiritual connections to country. We recognise their valuable contributions to Australian and global society. Tonight, we are thrilled to have Effie Zahos back, editor-at-large at CanStar. Channel 9 today shows finance expert and former editor of Money magazine, and Evan Lucas, head of strategist at InvestSmart, former Royal Bank of Scotland ABN AMRO analyst. These guys are really, really good at what they do, and I'm so glad to bring them in because they've got a ton of knowledge that they'd like to share with the audience that we have tonight. So the webinar format looks like this. So we've got a bunch of questions that was sent prior to this webinar starting. For the first 30 minutes, we go through those questions. And then the second half, please feel free to ask all your questions that you may have in the Q&A section. And then we can get started. So enter Effie and Evan. Thank you very much. How are we? Thanks very much for dropping by.
Hi, Andrew. How are you?
Very well. Thank you very much. Awesome. So question number one. Look, why should I invest in the first place? Effie, maybe you can get started on this.
Oh, gee. Well, I think I have this favourite saying of mine, and I might have shared it with you before, Andrew. Evan, I don't know if you've heard of this one, you may laugh, but my greatest fear is retiring in a polyester outfit and drinking cask wine. That's something I just don't want to do when I'm in retirement. Now, I know a lot of you are probably a lot younger than me and you're thinking, I'm not worried about retirement, but it's not even just retirement. I think especially now and now more than ever, there's a real big difference between saving and investing. And when we're looking at what the returns are in your savings account, it's just not going to cut it. You're going to go backwards. So for me, it's so important that you do start investing. And the beauty about having youth on your side beside everything else is that you only need to save and save often. That's the golden rule, isn't it? So look, I think it's important to get into that habit. And pleasingly, Andrew, I have seen what I've seen over the past 18 months now, we're almost into 2 years of this pandemic, is that our money behaviours have changed and people are becoming so savvy, which is great to see.
Yeah, much better. And I'm going to take over from there. So I'm completely with Effie with regards to saving is probably not the way. And I'm going to steal the screen. I'm going to get a little bit technical and actually use something that I've sort of put together deliberately, which is part of the other reason you want to start talking about basically looking at investing and expanding is that you've got to remember that technically inflation is eating away at your purchasing power. So what I mean by that is that when you go and do something today, it will be more expensive to do that in a week's time. More likely the best way to do it is a year's time. So very quickly with what's on screen, and it's not always the greatest example, I get that, but that is comparing the blue line, inflation over the last 10 years versus cash on a total returns basis. And what we mean by total returns, that's the cash that you then got as a dividend or some form of return with a term deposit, blah, blah, blah. And you put all of that money back in again immediately and reinvested it and just compounded that, the beauty of compounding. To show that against inflation and against the ASX on the same scenario of getting the capital gain that the ASX has had. And you can see it's had some pretty bumpy rides. And as Effie just alluded to, the COVID-19 crisis is very clearly obvious on that chart on the right-hand side, but also reinvesting your dividends. So what I want to show you here is that you can see here inflation over the last 10 years has actually increased the price of what you do by 18%. It's very, very gradual. It's very hard to sort of tell you exactly how it feels or what it touches, blah, blah, blah. But the best way I've actually seen to explain it is if you buy what the ABS describes as a standard loaf of bread in 1990, now I understand some of you might not have even been born when this example was given, but that's all right, was around about $1.73, top of my head. In 2020, that exact same standard loaf of bread was about $2.70. So the way to say that to you in another way is that if you had $10 back in 1990, you could buy basically 4 loaves and change. Now you can only buy 2 loaves and change. So you've lost out in terms of that's the issue of inflation. So getting back to Effie's point and my point about this is that inflation, you need to keep ahead of it. You need to keep beating it. You also need to understand that rainy days like COVID-19 are a fact of life, even though this is a once in a generation pandemic, and touch wood, it doesn't happen again in terms of our lifetime. GFCs, global financial crisis, obviously, you've then got, all these other things that can impact on what you do. Recessions, which we've just experienced for the first time in 28 years, although it's not a recession, I'd probably highlight because it doesn't feel like one in the same way that most of us would have experienced it. So why do I invest? It's to basically make sure, as Effie said, that when the rainy day comes, when the retirement comes, when your future kids get to school, when your holiday that you want to take comes, when that first home that you want to buy gets to, that you've got savings that are actually investing and growing for you that can actually get you the goals you want to do. Because in the end, that's what it is. What are your goals? What do you want to actually get from investing? And it should be a goal-based idea, because when you have the goal, it gives you the structure. It also gives you the strategy. It gives you the tenacity, I think is the other word to say to it, to actually want it and therefore actually start becoming savvy with your money.
Fantastic. Love it, Evan. Look, and it's interesting that you talked about goals, because funnily enough, we've got a goal webinar booked in for November this year. So please feel free to register for the future webinar about goal setting, which will cover off on certain kind of milestones and run it over a timeline so that you can get clear on what sacrifices you need to make today to ensure that you increase the likelihood of achieving those particular goals that you want in your life. Now, Evan, I noticed some words there. It's got equities, ASX 200, what are those things all about? And is it better to invest in shares or buy property? Because property is pretty hot at the moment, right?
Yep, so is equities. And I know before I answer this question, I'm going to say the answer is both, okay, before I annoy Effie with what I'm about to say. But in terms of why I say that is that in Australia, the reason the property market is so exciting is that it's tangible. You can touch it, you can feel it, you can change it, you live in it. It's a different way of thinking, because obviously your home is also your investment, and therefore, you can change it and do all that stuff. Equities are not the same. Obviously, they are on a screen. You do once upon a time, not anymore. You used to get a piece of paper saying, congratulations, you own BHP shares, or you own the ASX 200 in an ETF, blah, blah, blah. The other difference between the two of them, actually the two differences. First and foremost, unlike your house, your equity position is put up in big neon lights saying, this is how much your position is, down 2 cents. Today it went up 2%, today it fell 2%, it could fall 10%, could have increased by 10%. Your house doesn't have that. So that pressure that comes with equities every single day is a bit different. The other difference, and this is my big point, I know Effie's going to jump me on this, is equities, when you invest in them, or pretty much anything that's on a market listed, whether it's fixed income, equities, what have you, you don't do that with leverage. And by leverage, your mortgage, when you go out and buy your first home or your investment property, what have you, you go to a bank, you go and borrow, and therefore you put down a certain percentage and the bank gives you the rest of it. That is leverage, because all of a sudden you're only putting down a fraction or a percentage of the house. So you will turn around and someone will tell you that they, fantastic, they bought a house for $350,000, it appreciated for $100,000 to $450,000, and they made 100 grand off it. Whereas if you look at their equity position, they only made 1,000. The difference is that your equity position, you haven't used leverage. Now you can do that. The catch is that it's very, very risky, but there's also an argument that property is the same. So that they're not necessarily, in my view, different. You've got to put a lot more capital up. You've got to take a bit more risk on it. So for me, at the moment, in those age groups, equities, ASX is averaging 8.5% per annum. The US S&P 500's averaging 10% per annum. The Brisbane housing market for the last 3 to 5 years has been averaging 6.5 to 7. I know Effie's in Sydney, so she'll tell me a different one, because Sydney housing markets are just crazy. So if you compare them that way, the percentages show that equities are probably actually ahead, and over the longer term, they'll be ahead.
I'm going to jump in now. I think it's important not to get too too afraid of, or there's this whole thing of fear of jumping in. You're not quite sure, should I be going into shares? Should I be going into property? And as Evan absolutely said, clearly there is no right answer here. The good thing is you want to jump in. I think with also the advantages of shares is you don't need that huge deposit, because in Sydney, it's 200,000 for us, and for Brisbane, it's not too far off. You need that chunk to avoid lender's mortgage insurance. But I'm a great believer that most Aussies, unfortunately, have to get into debt to save. I know that doesn't make sense, but that's why mortgages are so appealing. You get that loan and you're forced to save. If you can force yourself to do regular investments and set up and reinvest your dividends, that's great. Most of us have all the best intentions of doing that, make a small investment, and then life gets in the way. A mortgage really nails you down and forces you to pay it. And what I'm seeing is right now, which that probably may not apply to yourself, is that there's a lot of people actually living in poverty and renting because they thought they'd go that investment plan, or for whatever reason it hasn't worked. So it's a good balance. A lot of people also do start in equities to get their deposit for a property. So they kind of go in that way anyway, because you can invest with, and this is Evan's area and Andrew's, you can invest with as little as $500.
Yeah.
And,
the other thing to pick up on your point there, though, Effie, is also when you use the word debt, there's a negative connotation in this country to the word debt. Debt isn't a negative thing. Debt is a tool, right? It's just how you use the tool. So you can use a bandsaw really well, but if you cut your finger off, you're going to get yourself into a lot of trouble. So again, there is, as we all talk about, I know, Effie, you're very passionate on this, good and bad debt, which is probably what I was alluding to slightly with regards to my answer, is that when you look at equities, there's no harm in terms of using leveraged positions in equities, but you've got to understand that it costs you, because with a debt, there's a funding source, right? You've got to pay for that debt, for that right to have it. So with your house, at least you know that you are paying to live. Normally at the moment, actually, and as Effie alluded to with regards to rent, there are, I think it came out today, even I think there's about 5,000 suburbs across the whole country where it's actually cheaper to buy than it is to rent. So this is the other thing. And at least you're putting your money to work, you're saving. Don't forget, when you look at a loan also, the part that catches you is the interest payment. Because when you pay principal and interest, all you're doing is you're just taking your cash asset and turning it into a tangible house asset, and you're paying down your loan. The only thing you're losing out on is having to pay the interest. So that's the beauty of it, and that's good debt. Debt is working for you, is that you are slowly but surely earning and owning more of that house or more of that investment and paying a small amount of interest. Yeah. It's when you start doing personal lending or those kind of things to go on an experience, as much as fun as it is, and by all means, I understand it, but that technically is bad debt, because there is no way of actually using that asset, that experience as an asset to then grow for you.
Yeah, leverage is a double-edged sword. You have to be extremely careful, because it can push and amplify results upwards, but it can also amplify results downwards. Just talking about GFC, right? Storm Financial, for example, you have to be extremely cautious, because as an investor, what you need to do is ensure that you keep playing the game and you don't put yourself in a position where you risk getting out of the game completely and starting from zero, right? This is where leverage really rears its ugly head if not structured properly, right? And you got to understand, when you get into the investment space, you need to understand the risk associated with the investments, right? Effie alluded to earlier, some people want to invest in equities to save up for that deposit. Now you have to be careful, because sometimes there's a timeline there. And if you can get caught on the downturn, you may have to save a little bit longer. So you just have to be careful on how you run this thing. And Evan, you showed us a little graph earlier. Actually, I'd love to kind of pick your brain about that one, because a lot of people tend to forget about the time horizon when investing, right? So if you're looking at a 20-year time horizon, it's all well and good, similar to what's happening in this graph here. But if you make that smaller, for example, if you're looking at acquiring that first property, which we'll be covering on the next webinar, by the way, right? It's a little bit riskier, because as you can see there, if you get hit and if you're looking to acquire it early 2020, let's hypothetically say, and you get caught in that COVID, you may lose a large chunk of your deposit.
Right? I'm going to pick you up on that, yeah, because that's all part of the whole thing. But I'm going to pick you up with what the chart's on screen is. This is the other thing about what Effie and I have sort of started with, and we're both in the different phases of lives that we're assuming that you guys are, because we know that most of you are, probably 30 and under. We know there's more of you out there that are above that. The most of you listening to this or watching that are under. So time, I know one of the questions we were discussing before this whole seminar, and I'm going to jump in, and I'm really sorry to Izzy and Tara about this, but the one thing that I learnt from when I started to where I am now is that time is so hard to understand when you are young. It is, I'd love to think that I'm not young anymore. Apparently I'm not. I'm now 36. I'm creeping to the wrong side. But what I've learned is time. And so listening to what Andrew just said, and the charts on screen, this is 5 years of the ASX 200. And why I put this here is the other thing that we love talking about is compounding. Now, you would have learned about compound interest as a year 9, year 8-year-old, and they would have shown you that beautiful exponential chart about what it does. I'd rather show you compounding in real life. Okay, so this chart is the ASX 200 against the top 200 companies in Australia on a capital growth basis over 5 years, and then the dividends they give you on top of that reinvested immediately and showing you the difference. So that's what the sort of dark blue line is and the green line is. The other one I've put in there also is what I also remember when I started is that I was conservative. Now I know listening and already seeing some of the questions that have come up, some of you are not, some of you are very, very aggressive, and that's fine, is that going in cash was the way to do it, term deposits or cash management account. And that bottom bit, I just want to show you there is that cash now over the last 5 years has actually gone backwards, not including inflation, we discussed before. And on total returns basis over 5 years, it's given you 9%. And to Andrew's point before, this is over 10 years. So that's the exact same chart, just with longer time. And at the bottom, you can see the percentages. So I'm going to put that away, but just wanted to amplify Andrew's point is that it's so hard to quantify time. And the other thing that comes with it, quantifying time and risk. We talk about risk reward in our industry. There's a chart that you can see everywhere is that the more risk you take, the more return you're going to get, but the more time in the market you need to spend to get over a COVID-19 crisis. Now, nobody knew that it was going to recover like it has. And let's be honest, nobody has seen anything like this. GFC took 2.5 years to recover. The ASX, if you were the most unlucky investor on the planet and invested on November the 1st, 2007, the peak of the ASX, it took you 11.5 years on capital to get back. But if you reinvested like this, it only took you 4 years to break even. So that's the other thing you've got to remember is how you go about doing this.
That's great.
Is a great answer.
I think I'm going to have to bring Effie in this one, because there's a question here. What do I need to consider before making an investment? Because we're hearing a few terms now. So what I'd love to hear your thoughts about what kind of processes would one need to go through to do that. I
think the key thing is what we have. I'll kind of start on where you guys have just ended. So time is of the essence, but try and keep it, let's strip it all back here. Let's try and make it as simple as possible for us, because one of the biggest things I do see is people don't jump into investing because they think it's so complicated. For me, it's a case, and I think I said this just a moment ago, save little, saved often. So your time is really important. So when it comes to considering what you're going to invest, why are you investing? It's really hard to start investing if you're just forcing yourself to invest. Often we have to put a goal there for it. So is it to hopefully when the borders open, you can go on a holiday, go over to overseas, or is it to buy your first car? Is it to buy your first home? Is it to build wealth? Is it to bring in a second income stream? So I think it's important you need to kind of write down what you're actually trying to achieve here, because then that determines, I guess, where you'll then put your money and what is your risk appetite. But for most things, I keep things pretty simple. In most cases, and depends on what the goal, it is either, do you jump into shares? Is it property? Am I going to build super? Do I want to get an investment property? Invest in myself.
All.
Yeah, yes to all of them. They're 5 little things. And always invest in what you do know. But the important thing to start investing is to get educated and then understand, what am I saving for? Because that's going to determine a lot. If it is just to go overseas in 2 years' time, unfortunately, I hate to say this, you might have to play the game of finding an online saver. The best one's paying 3% at the moment, as long as you're under 30. It could then, can I take a little bit risk in that 2-year period? Yeah, maybe, absolutely. And Evan, you can jump in here. There's lots of robo-advisors out there. InvestSmart is one. For disclosure, I sit on the board. Evan is actually paid by them as well. So, there's SixPark, there's StockSpot, there's lots of them.
So I'm going to pick you up on that, because I think what you're talking about is a really good point, right? So by all means, go on that overseas holiday when it happens, and I can't wait for it to happen. But what you should be thinking about, and what Effie's describing there, is you need to basically look at things as a whole rather than one individual. So what I would argue to that is a strategy that I know Andrew talks about a lot, and what he does as well, is I would be thinking, okay, what's my 0 to 2 year time frame? What's my 2 year to 5 year time frame? And what's my 5 year plus? And have them. I mean, it's a really simple old stuff. You teach kids this. Like I teach my 3-year-old this. Is that this is my now product, this is my future product, and this is what I want in a rainy day. And you should be putting into each 3 of those buckets. It's called a bucket strategy. It's not hard. It's not simple. It's not. So you shouldn't be thinking about just the one. The typical bucket strategy is, this is my living here and now. I need 2 years of money to live here and now. This is what I want to do. And this bucket should technically, the 3 to 5 year, slightly fill over the 2 year bucket. Then your 5 year one's more aggressive. This is what Effie's talking about. This is, you invest, you start to actually look for that longer term. And if you put, small amounts, but often into each 3, and they let them do what they do, all of a sudden you'll see that your savings has become an investment, and it's actually given you a return that you were hoping for. The other thing that also I think we should probably talk about here is that when you're first starting out, it is very, very tough, completely understand that. But the biggest issue, and this is what I love psychology, I love psych and finance, is that the 2 biggest problems, greed and fear, start to really hit you when you first learn. So I've already...
While we're on that topic, Evan, sorry to interrupt there. What I'd love to get is a quick answer to these questions. How much do I need to start investing? And what platforms can I use to start investing? So we talked about InvestSmart as one of them. Any other micro investment sites that are out there for people to consider?
I'll just jump in quickly, and then I'll let you take over, Evan. But you hear people say you only need $500 and you can start investing. Yeah, okay. Technically, that's what a trade will get you through. It's not going to give you that diversification. So let's think about, an Afterpay share, if that's what you want. You'd be lucky to get, 5 on your hand, so to speak. You want that diversification. So
get one.
Sorry?
You get one with $500.
Yeah. In most cases, what you're looking for is obviously a little bit more coin, so to speak, if you're going to invest directly. I'll just jump in on how you can invest indirectly in that regard. But there are lots of platforms that have come out, which is exciting, but take real good care and do have a good look at what fees these platforms are charging. So I'll give you an example. I have a 20-year-old, and she jumped into Raise, and Raise was something that suited her at the time. It did. She spending on a debit card, round up, it whetted her appetite to learn more about exchange traded funds. So it was great. But then she soon realized she's not spending enough to round up, and her balance was quite low, and she was really concerned about the fees eating into it. And that's just an example. There's lots of other ones. So the smaller your balance, the bigger the punch your fees are going to be. So take really good care at these platforms that do take in small investments, because the fees are likely to impact you. But I still think for some people, they're a great way to wet their toes, to have a look and see how they work. So, you can either go direct or indirectly through these platforms. And there's quite a lot out there, just to name a few also: CommSec, Pocket, Raise.
Self-Wealth, Spaceship.
Yeah, Spaceship.
All those kind of guys. I'm a little bit more cynical on this, because I know Effie's much more balanced than I. The cynic in me also, getting to what Effie's point is that the business model of those companies, in my view, is probably slightly against you. And what I mean by that, they need you to transact fairly regularly to make money. I mean, they're a business. They're offering you a service. They're offering you a platform to go on to buy ASX shares, US shares, European shares, whatever it is. Yes, it's incredibly cheap, but they need you to do that over and over and over and over and over again. So just be aware of that. this is the Robin Hood effect. So for those of you who are out there, and I can see again, looking at some of the questions, some of you would be very much over what Robin Hood in the US is. Part of the reason they're under so much pressure is because the products they're offering are designed to try and make you do more. And that's when you start breaking strategy. And as Effie's pointing to, that's when you start breaking your investment, because they're actually going backwards. They've been eaten by fees, and you start making risky things to try and catch up the fees. And that's when you lead to mistakes. So that's the cynic in me around this. The other way to look at it is $500 is great. Understand that, but you're probably better to do $500 in cash, even though I just showed you charts you shouldn't, than doing $500 in equities. And the reason for it, just like I said, there's charges. So let's look at a CommSec as an example. You have to pay $20 to buy in, and then $20 to get out. So you've got to, if you're $500 investment, you need to make $540 before you get out to break even. And that's a huge increase in whatever share you're doing to just to cover brokerage. So when you get to, it's again, economies of scale, the more you can invest in one shot, the better. We'd probably recommend, and again, not advice, but probably starting at $2,000 is about where you'd want to be. And I understand, again, this is what I remember from when I was first starting off. $2,000 to you guys is a lot of money. And I get that. And so does Effie. We fully understand that. And that may be sort of part of why we're talking about exchange traded products, and why I have moved from direct equity investing into ETF investing. Because although I do this for a living, I don't have the time to personally watch my portfolio all day, every day. So I know that I can get 8.5%, 10% from ETFs. So why not do that? And it's much cheaper. So I can put my $2,000 into 200 stocks immediately with my $20 cost from CommSec. Now I actually use NAB Trade, and they're $14.95. And therefore get the diversification that comes with that immediately, with a very low cost to me, because it cost me about 0.04 of 1% per annum to invest in that ETF. From BlackRock, that one is. So it all of a sudden gives me that scale I need that Effie's talking about to start. And by all means, then go and get your other shares when your portfolio starts to grow. But that's the core. At least you've got the diversification in the product. It removes that cynic view of mine that you're trying to chase something. And it gives you a base that you can get with a very low amount of investment money to start with.
Absolutely. Now, I just recently ran a poll. Have you made any personal investments? 86 said yes, 49 said no. Now, this is a nice little segue for you, Effie, because we actually, believe it or not, if you have worked in Australia, you are an investor, believe it or not, right? With your superannuation. If you haven't made any investments outside of super, right, you certainly have been investing within super. So, Effie, quick couple of questions for you. Should I be thinking about my super in my 20s? And to top that off is, how do you get the top super funds? Where do you go? How do you find this information to ensure that you put yourself in the right position to capitalize on that long-term gain?
Great questions.
So excited that you guys are loving super. And I'm just going to throw that word that you love in. You probably don't like as much as that. And especially at where you are in your life right now. Look, I mean, obviously, if you're 20 and you've just started work, and this is an example, again, I'll go back to my daughter. She's 20. She's got a part-time job while she's at uni. And she's so into super, and that's probably my fault. And, you know, she does contribute and so on. And I'm feeling, okay, hold it. You might need to calm down a little bit because you've got other objectives here, and exactly what Evan, you were saying about those buckets and where you want to go. But let me just tell you a little bit about super. If you haven't yet jumped online and had a look at your super funds return, do so. Your return should be on there. Your statements won't come in until about August, but your return should be there. They've had a stellar run, an absolute stellar run. And super the long term, but let me just focus just on the last year. And this is the numbers that Andrew and Evan were talking about, you know, just how we've recovered. 20% returns, I think, the largest super fund in Australia, Australian super fund returned last year.
And that was balanced.
Yeah, that was balanced. And that's probably what most of you guys are in, or you might be in a default fund, a My Super default fund, and you've chosen it, but that's a balance, more than likely. So they've had a great run. So before I tell you who some of the top performers are, it's important to note that this is a no-brainer. Your boss is going to pay you 10% of your salary as a super going straight in there. Or maybe you'll be self-employed and very successful. Then you've got the tax perks and it's a tax deduction and so on. But for most people who get a paycheck, it's going to be 10%, and that's going to grow. The important thing is you recognize that this is your money. Yeah. Really get your head wrapped around that, and get wrapped around it now, because the difference between being in a dud fund and one that performs well is amazingly, the difference could be 200,000 that the Productivity Commission has actually shown from a dud fund to a great fund. My question is, I'd love to know, do you know how much super you should have right now in your fund to see if you're on track to live a comfortable retirement? I don't know if you do. And what is a comfortable retirement? I mean, we've got some figures out there. ASFA says you need 640,000 or 545 for single by the time you retire. It's all very personal, but if you've never been on this website, I say you should go onto it. It's ASFA's, it's Super Detective. You just type in the year where you're born, and it would tell you how much super you should actually have right now. So I did that for a 30-year-old. So if you're 30, you should actually have 54,000 in there right now. Unfortunately, the average is 27 for male and female is 22. That's not too bad. As those numbers go up, as I look at older ages, the gap is huge between what you should have and what you shouldn't have. And whilst these are just numbers by ASFA, it's a very personal thing as to how much money you should have in your super. It's important to keep track on what's doing. It's really simple when it comes to choosing a super fund. Well, it can be simple. The government has launched a My Super tool. It's a comparison tool. You'll find it on the MyGov site. It only does my super funds at the moment, not retail. You can go on sites like I also work for CanStar. You can go on there. They've got those as well. You should look at over a 5-year period at least, or 7, it's performing well. And the top 10 super funds, and this is taken off as of the end of May, I only got this. They've changed a lot again. They're the likes of Hester, Australian Super, Host Plus, Sun Super, Vision, Cbus, Q Super, Aware, UniSuper, and Care Super. These guys have returned over like a 5-year period, some of them up to 10%, around 9, 8. If your fund's not doing that, then you've got to ask yourself, why is my money sitting here? You can move it. And the biggest tip I can give you now is take care, because from November 1, your fund will be stapled to you. So you kind of forget these things and you will move with that super fund for the rest of your life if you don't change it. So take care on that. A couple of things just to note: when you do look at your statement, your end of year financial statement, you want to see your balance. You want to see your total fees. Add up your total fees, divide it by your balance, times it by 100. If you're in a balanced fund, you kind of want that under 1% in fees to be sharp. Otherwise, you're getting ripped off with fees as well. So these are these little things you can do to make sure that your nest egg is there for you. You've got a lot of years ahead of you. I'm not saying salary sacrifice right now. Maybe you can, great. But you can do these little simple things to make sure that your money is working for you now.
Just on that, just going a little bit further, for those of you that exactly what's Effie's point, the way to get it invested into you, particularly if you're trying to get super around your overall thinking and how you can live and breathe it, it's what these are for, right? Get your app. Your super fund now has finally woken up to the fact that it should be telling you what you're doing on an app, and they're all the same. You can go on there and do whatever you need, and you can just click on it, and every day you can see it. If you look at your cash balance of your bank account and think of your super fund the same way, you'll start to live and breathe it. So that's the way I've started to talk to people that are like, I just don't care about super. I'm like, right, go on, get your app, and every day when you check your bank account, check your super balance.
And the
story. Yep, you go ahead, Effie.
I'll just add one more thing to make it more relatable as a bank account. And again, depending on your priorities, you may not want a salary sacrifice. So salary sacrifice sounds like such a terrible word. It sounds painful, but it's actually kind of paying yourself forward. So for every dollar you put in your super fund, you're only charged 15%, as opposed to what your marginal tax rate is. And I'm assuming you guys are all paid wonderfully high. So there is a real benefit to maybe doing that. The most you can put in is $27,500 now. That's gone up a little bit. In my bracket, what I'm doing, it suits me for my age. I actually have it on my bank account. I have it as a BPay. So when I go to pay my bills, there's my super fund, and I just swipe it over like a transfer, like I'm paying someone. And it's so easy to do. So for me, it's that relation, is what Evan was saying too, that it is a bank account. Make sure you actually look at it.
And the beauty of this bank account is that it is the only bank account that you cannot touch, right? So you're practically forced to invest. And the beauty is you will tap into the compounding rate of return, right? You will start to compound over time. You work over a 30, 40-year period. Oh, amazing.
The final one on all these stats. If we are really conservative, so not what we've just seen in the last 20, the 20%, and even the average of the 8%. If you were to average 6% in your super fund, it means without doing any additional adds to the 10% you get in your super, but your super fund will compound by doing what we showed before, that total return. It does that for you naturally. Every 12 years at 6%, your money will double. So think about it that way. So at 22, if you're at 30, over 12 years, you're at 44, doing nothing in terms of that at a conservative level of 6%. Not including the fact that you're adding 10% of your salary every 2 weeks or a month or whenever you're paid on top of that. So that is the other beauty of super. Remember it that way, that if you're a really conservative super fund at 6% per annum, your money will double after about 12 years.
Can I just add to a lot of questions that I get is that I don't have extra money to put in my super fund. And I get that. I absolutely get that. But some of those tips I gave before didn't require any money. Another one as well is that there are lots of, you've probably heard cashback sites when you're shopping and you get the commission back as you're shopping. There are a lot of cashback sites now that allow you to take the commission and put it directly into your super fund. So you can kind of have best of both worlds, shop and save. That's what I like.
Question here. What would you think are the biggest mistakes young professionals make when investing, and how can they avoid them?
I've been said, I'll let you do that, Effie. But as I said to you, my biggest mistakes at the start was not understanding time, being pretty gung-ho, thinking that I obviously knew exactly what I was doing when I didn't. And also not doing my research properly. So I always put my hand up. When I first started in this industry, I was a broker and was doing that, talking to clients. And I didn't do my research enough about the analytics behind it. So the biggest mistake I ever made is a company called Bought Longyear. And to this day, I still use it and pin it against any wall that I have to work near to remind myself of how stupid I was around that company, because I basically just went completely into it without really understanding what I was doing and where the company was at. So they were the big ones, is understanding time, but not doing my due diligence. And I was an analyst, right? And that really annoyed me. So that sticks with me like no tomorrow. Is that mistake was huge.
Mm-hmm. I guess for me, my mistake actually was, and for someone who's so passionate about super, I wish I actually did start salary sacrificing only just $20-$50 each pay. I was a graduate, got snapped up by Westpac. We had a financial advisor come to us and said, do you want a salary sacrifice? And I've written about this because it kind of bugs me a lot. My mate goes, yes, I'll do it, and $50 per fortnight. And when you're at that age, you can afford to, you don't have, I guess, other commitments in that regard. You've got all the cash in the world. But I guess it goes back to Evan's point too. I just didn't understand that time concept myself. It was like, retirement, you're kidding me. That's so far away. So I wish I did that, but automate it. Whatever you do at this stage, automate it. I think, having your first job or in your first role or whatever that may be, you're excited about that. Take some time to think, okay, I've got this serious money coming in every fortnight, every week. What am I going to do with some of it? And automate it. Pay yourself first. I think that was what I should have done instead of had, the roaring 20s. I think I had some roaring 20s.
Look, I'm going to share with you a story. Like I tend to get a fair few people coming through my doors and talking to me about their finances. And the most common one that aggravates the hell out of me, and it's a contentious topic, is that people tend to want to buy new their property, right? They buy new, not realizing that they're paying the profits of the developer, the builder, the marketer, and the real estate agent. Now, what does that equate to in terms of opportunity cost? It typically takes 5 to 10 years before that property grows in value, right? Now, what are the perks associated with buying new? Well, the accountant will tell you that it's a massive tax break and you get that through depreciation. In my humble opinion, right, I would rather you buy a proper property or dollar cost average in the share market. Proper property being land or infill, house and land in infill sites, right? And obviously we don't have time to go through that today, and we can go through that in the next webinar. But I really, really want to tell you, please, if I can implore you, do not buy new because you're literally going to be shooting yourself in the foot financially, right? So yeah, that's my little rant.
Can I just jump in here, guys? Because I've just
please.
seen on the chat, there's a question that I think we need to really ask, considering that obviously we are talking to UQ and you guys are obviously still paying off or are thinking of paying off your HECS. And I think it's the question that we need to ask. Could you give me advice on whether or not it's worthwhile actually paying off your HECS debt before you do anything else? I know my answer. I'm going to let you two go first.
I think I know. I think you know.
I know we're the same on this. Don't do it.
Yeah, 100%.
Don't do it.
I think you're wasting your time. It comes down to return on investment, cost of capital, risk-free return, right? If it's getting you 2%, right, I would be looking elsewhere. It's literally like saving cash, putting in a bank account.
It's the most specialized loan you can get. You do not, as a personal person, as a retail client, you cannot get the rates that HECS gives you anywhere. You just do not have the ability to go to the Australian government and say, can I please borrow off you? Because that's what you're doing. And it's tied to inflation. It's the cheapest loan out there. Yes, you might not get a tax return, but be honest with you, who cares? Because as Andrew and Effie have just pointed out, the return you get elsewhere is going to be significantly better than trying to pay your HECS off.
You're going to jump in. If you're getting a home loan, then I'm going to say it's going to knock down your borrowing power by quite a lot. So, and there's a lot of great borrowing power calculators online that you can play around with, and you can see if I have, a $30,000 debt, how much less loan can I get? They're scenario driven. I wouldn't, treat it as gospel, but it will lower your borrowing power. So it's a case of if you are thinking of applying for a loan, then it might be, but then this is the juggle. You're trying to get your deposit together as well, and you're throwing that down. But then if you're buying your first home, and again, I think I'm going into a property seminar now, you need to take advantage of some perks that are out there too for first home buyers as well. There's lots of those as well, whether it's stamp duty, whether it's 2% home loans, and the rest. Well, 2% is for single parent.
First time super saver scheme. But Effie, we'll have to slow it down, and we're going to save all of that good stuff for the next webinar. Now, good rule of thumb for you guys is let your career progression pay for your HECS debt. It's really as simple as that.
Yeah.
You can find a better return on investment elsewhere. There's a whole ton of investments that you can invest in that will outperform against that, right? So now, before we keep going into questions, what I'd love to do here is basically ask Effie, where do we find you? Like, how do we do this? Where do we find you best? Let me quickly share my screen here so that people can see where they can follow you, basically.
I thought you actually wanted my phone number.
No, I wouldn't want to do that. So Instagram, you're quite active in Instagram. I know I follow you. I keep an eye on your content.
I'm very active on Twitter, so you'll always get me answering back on that. But look, you can find me. Look, I'm on Today's Show every morning. You can find me at CanStar. I have a free money newsletter that goes out every Monday. There's also a free super guide that I've put together. I'm really proud of that. It's an e-magazine in association with ASFA. That's on CanStar's website as well, and that's free. That took about 3 or 4 months to put together, and it takes all the latest changes that have come in on the 1st of July and strategies that you can actually do for your 20s, 30s, 40s, and that's free. But yeah, you can reach me definitely on Twitter if you ever need anything.
Awesome. Thanks, Effie. And for myself, you can find me on Instagram, LinkedIn, and if you're keen, you can feel free to book in here this particular QR code where I go through winning property portfolios, funnily enough. I go through 4 hacks: acquire more, acquire fast, utilizing lazy equity, super and property, right, and how to capitalize on leverage safely, right? So tonight at 7:30 or next Thursday, 1 p.m. or 6 p.m. Now, Evan, where do we find you, mate?
I'm a bit like Effie. I'm pretty prolific on Twitter. You can also find me at LinkedIn, so I'm down there at the bottom. What I think there's a question here, at least in the chat from Samantha, is what are the good research to understand terminology and the options, et cetera, blah, blah, blah. Part of what I'm really proud of at InvestSmart, and probably what we've been talking about tonight, is financial education for us is really, really important. So Effie, I know, has gone through this for us before, but myself and another colleague, Tom, put together the InvestSmart Bootcamp, which is basically an 8, now going on 9 to 10 module program to basically educate you in these terminologies, all the stuff we've discussed tonight, how you can go about doing it, giving yourself that financial base education to get you going. And I also discussed with the CEO to basically make sure that I can give you student rates. So it's $25 rather than $50. If you click on that link there and type in the code, I think it's behind it, I think it's UQ25 Bootcamp, or just click on that link and it will take you through and you can go through that program. Once you get into it, it's basically yours for life. So it's a program that I'm really proud of because it is basically taking what we're doing tonight to another level. It does have questions, it gives you examples, all those kinds of things to really sort of give you that confidence to actually start your process, whether that is in super, whether that is in investing like Andrew's talked about, whether it's even just getting a better understanding about how investing works, where the markets come into that, where listed property comes into that, all that kind of thing is what Bootcamp is. And we're really happy to obviously offer that to you at $25 a pop.
That's awesome. Thanks, Evan. Much appreciated. Okay, so this is our next one here, buying your first property. Please feel free to scan that, register. Now, I noticed there's a few questions here around ethical investing. Do you guys have some thoughts that you'd like to share about ethical investing whilst the audience scans this QR code and registers for the next webinar?
Ethical investing is a really beautiful thing. In terms of its return, it's actually the other thing that's starting to happen is it's starting to actually even up, if not slightly outperforming its non-ethical, if you want to call it that way, peers. There's still a long way to go. The other thing that you need to also remember with ethical investing is, like anything, you need to do your due diligence, particularly around if you're really strong on this. So ESG, to get an ESG registration can actually be pretty simple. So you need to make sure that if you're really strong on ethical investing, that's fantastic. And if you see a fund that is performing really, really well, you need to weigh up what they're doing. So there are, the RIAA is one association that's very, very good at doing what they do with ethical investing. There is also, you can go on places like, they're now called Refinitiv. They used to be called Reuters. They actually have a breakdown of all of the funds that are ethical and they rate them to how ethical they are, how close to environmental service and governance they are. How many women do they have on boards? Do they have a 50-50 split? Are they, working with Indigenous communities? Are they returning the land to the way it was? All of those kinds of nitty-gritty data that you might want, they will have it. So you can actually understand, which is really hard to say, BHP, for example, has actually quite a good ethical rating because they work so hard on social and so hard on governance. They suck at environment. I understand that. They're always going to, but they are getting better because as soon as they finish, they make sure the land is redeveloped. They make sure that it goes back to the communities, that it can be producing outside of it. So that's how I'd argue ethical. It is a very growing thing, and by all means get into it. But like anything, do your due diligence because an ethical fund can scrape through much easier than you realize.
Yeah, if I can just say, I've noticed that funds under management of them have grown quite a lot. So absolutely agree with you, Evan. There's a great interest in there, but I would have to just reiterate exactly what you were saying as far as what is it that they actually are investing in and not investing. And also as a bigger group as well, probably one of the problems I have is that some institutions will come out with an ethical investment, but the rest of them, oh my goodness. So where do you stand with that as well? But yeah.
Okay, so we've got enough time for a last question here, but really, theoretically, we should finish at 7, but Effie and Evan were generous enough to actually stay back for another 5-10 minutes if we've got a ton more questions. So feel free to just bombard us with more questions. But the unofficial last question, from what I can gather here, is there's the question of, well, is it better to invest in shares or is it better to invest in super? So, I mean, there's some misunderstanding there. So I'd love for one of you to unpack that for us, please.
I'll quickly jump in before Effie does. So you've got to look at them that your super fund is investing in shares. So this is the answer to that question. I think that's what Andrew's saying with regards to the slight misunderstanding. What we've been probably discussing tonight is your inside and outside of super investments. So that's the answer to it, is that you can't touch your super till you're 67. So for me, I'm obviously still 30 years away from doing that. And for you guys, it could be 40 years from doing that. So there's a gap. There's a big gap of time. So that is where what we're saying is your shares now, or your investments now, versus your super investments for later in life. So that you're investing in super is in equities. You're investing now can also be in equities. They're not independent of each other.
Yeah. And that's the key point. You can't touch that money in your super till you get to your preservation age. You do have, I guess, that the tax perks of, money in your super fund, which is key. I mean, really, you could kind of build your wealth, draw it down, pay no tax and so on. Andrew, that's your area of expertise. So there are definitely some heavy tax perks with super. But as Evan was saying, look, you need an income stream as well, because super rules can change. You need outside of super, because super rules can change, and you don't want to be in the mercy where you have built your wealth to find out that they've changed something. In most cases they don't change it; it's backwards. But they may increase the age; it may be even older.
Well, that's exactly what I was going to say. Is that the age is the one here? That's the simplest one to point to. Is that it was 65, it's now 67. Yeah. If you look at the intergenerational report that came out 3 weeks ago, this is something that really makes you sit up. Our generations are going to have to rely on themselves more than any other generation before. You cannot expect to get an age pension when you get to 67 if you are in your 30s. You definitely can't if you're in your 20s, because unfortunately, we've got an aging population with a lower tax ability to service that. So the other way to ask it is, you then need to look at it from the point of view is that, okay, if I'm having to get to 70, the other thing we know is that healthcare is going to get more and more expensive. COVID has proven that, and it's just going to be another example of it. So you've also got to start thinking about funding those things. Super will probably have to, and the changes could be that, Medicare could pop into that, or private health insurance could pop into that. So that's all those kinds of what if questions. I get it. But the big one is that I'd be fairly sure that by the time I get to my retirement age, it's going to be 70, not 67.
Well, I'm lucky mine's around the corner, Evan. So
you've still got time, my friend. You're still a fair way away. Right?
So a quick story. My wife and I were just doing some sums last week, and we've got 3 girls, right? So 2-year-old, 3-year-old, and a 4-year-old. Lucky me, right?
Yeah.
And we were asking ourselves the question, well, how do we set them up financially? And at what step? Well, the next obvious question after that is, at what stage in life do we want to help them financially as well? Because obviously you don't want too many safety nets, because you want people to be financially resilient. And the idea came to mind about super, because one particular strategy that you may want to consider if you've got kids, right, is if you can put in as little as $1,000 per year for the first 20 years of their life, that will typically grow to approximately $49,000, $50,000, right? Now, if they leave that in their superannuation at 8% return over the next 45 years, they get a whopping $1.4 million. Now, that is the power of having decades behind you as an investor, right? 20,000 down, 1.4 on the back end, right? So what I suggest you do is consider what Effie was talking about. $50 per fortnight, or even just $20 per fortnight, can make a massive difference for your 40-plus-year-old self, right?
Yeah.
So you got to ask yourself, well, what can you afford today? What can you scrimp and save? You can literally stop 5 coffees per week and set yourself up for your 67-year-old self, right? So something to consider, guys. It's worthwhile.
And there's a great little calculator that what Andrea was just saying. Again, if you go in the Super Guru's calculator, you'll find there is exactly that, these little icons. If I stop one coffee, if I stop one movie, if I stop one takeout dinner, I'd have a very boring life. No.
I can't stop it all. Yes, absolutely. Oh, interesting question I saw here. At age 40, is it too late to invest?
No, it's never too late. There is never, ever, ever, ever a date or an age or something to say it's too late.
You've got 40 years plus ahead of you. That's another life.
Yeah. My favorite thing I've written in the last 18 months was an anecdote I wrote about my mum, who's currently upstairs, because I've actually had to run to Adelaide because of what's going on in Melbourne, because we were coming over here for holidays. But the reason I highlight that is that I'm not going to divulge her age, but she's in her later 60s. And for many, 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 many years, ever since I started this, I've been trying to convince her, and she finally started in October last year.
Oh, good time.
Yeah. And not only has she done that, she now does what Effie talks about, which is small amounts in every fortnight. She's actually now jumped it up to every week. The balance that she has all of a sudden grown by around about 13.5%, because obviously it's been a good period, but also she's gone and topped up even harder because and now she says to me, I really wish I started earlier. And I'm like, don't think about your opportunity cost as we refer to it. That is not the point. It's now that you started, you can see what it's doing and you can see what it's going to give you in the future.
Yeah. I absolutely agree. It's never too late to start. And you know, that $100 compounding interest, what you'll find off the top of my head, correct me if I'm wrong, guys, it is normally around about what year 10 you start seeing that the heavy lifting is done by compound interest. And then it shoots off after that. So
exponential growth.
Spot on.
It definitely gets out of control. It grows exponentially, like what Evan mentioned. Now, quick Chinese proverb: when is the best time to plant a tree? Right, obviously 20 years ago, but the next best time is today. So get started. Right, there's no harm in getting started, so long as you're not putting all your life savings on one stock. Right, so the key thing is to differentiate between a gambler's mentality versus an investor's mentality. And that's why you come to webinars like this, right?
Yeah.
Coming to webinars like this will help you actually build the reps that you need in your mind to actually become a proper investor. Now, what I want to share with you guys is that this particular webinar, the replay will be available, will be sent out to you by email. And like I said earlier, we want to thank Effie and Evan for staying on. They decided to stay on for a little bit longer, and they've been very, very generous with their time. So we're very, very grateful. So question that I see here: what is the one smart investment move you regretted not doing when you first graduated? Now, Effie, you mentioned about super. What's the second one that comes to mind for you?
So regretted is only super. I must say, sometimes stupidity can work out really well.
Mm-hmm.
So for me, it was jumping in, probably. I mean, when I finished uni, it was just, I really didn't know much about the share market. Yes, I did an economics degree, didn't really know the ins and outs, but I basically jumped in and just bought a whole lot of bank shares. So CBA, Westpac, NAB. And so really didn't know. I just thought, okay, I'm going to work for a bank. I think I might as well invest in a bank, and jumped right in. I mean, that was when, you got to remember, that was when Commonwealth Bank was sitting at like $2 or something like that. So sometimes that being naive and jumping in, it can work, but I wouldn't recommend it all the time. But yeah, my biggest one it is super, I must say. Super, and not automating my savings. If I'd done that earlier, I jumped in that. I did that in my 30s. But so I've lost 10 years, and that 10 years is like we were just saying, it's that 10 years where you start getting that exponential effect.
Evan?
So for me, it's not really not what I did, it's more what I did after. And what I mean by that is that, like Effie, I jumped in, actually managed to create what I thought at the time, and actually now in hindsight, it was a good core portfolio. But then I did something really dumb, which is, as we discussed tonight, I wanted to go overseas. I was desperate to do it, and I liquidated it all. So that was my biggest, dumbest mistake.
Really?
Is that, yeah, I did. Because...
do you count an experience a mistake?
No, absolutely not. So what I mean by that is that I could have kept them in there and wound them down as I needed. Not doing what I did, which was go straight to cash and then forget about it for 5 years. So when I was 21 to 23, I had a really good portfolio, got an opportunity to go to Amsterdam, went to Amsterdam, working as an analyst in equities for for God's sake. And the mistake was that I basically liquidated my cash because blah, blah, blah. That is my single largest mistake. Thankfully, I was 27 when I could make it up, and I did. And I bought my first home as well, and I've got all that in the back of it. But yeah, that's my biggest mistake, was liquidating when I did not need to. And by liquidating, I mean I just sold everything and went back to cash. I realize I'm using a buzz term. Really sorry.
Well, you covered off on dollar cost averaging on the exit as well. So I don't know, did we cover off dollar cost averaging?
No, we didn't.
So it's a common term used by finance professionals. Evan, do you mind sharing your knowledge around dollar cost averaging?
Yeah. Okay. So actually, the best way to do this, I'm going to go back to sharing my screen. So dollar cost averaging, this chart is the best way to explain it to you from the point of view that you can see it's really jagged, really aggressive, I think is the word in terms of what's going on there. When you look at dollar cost averaging, you don't care about this. And the reason for that is because you're buying today because you're thinking about 20 years. Then it means using Effie's, what she's been talking about, which is that adding to it slowly but surely. Tomorrow, it could be a little bit lower, which means, let's say $1,000 invested today gives you 1,000 shares. Tomorrow, it could fall to 900, it could fall from $1 to 90 cents. So your $1,000 investment obviously gives you 1,100 shares. So all of a sudden, the average price of those two together is about 95 cents rather than $1. If you keep doing this over and over and over time, your average price will just basically flatten out all of that aggression on screen. It will also mean that during the high times, you get a little bit less. Yes, low times you get better, but your economies of scale, that stuff you learn in economics, all of a sudden your nest egg is much bigger. The compounding that Effie's been talking about at 10 years comes forward because you've also got a scenario where instead of having $1,000 or $2,000 in the example I've given, you could be at 20 grand, you could be at 30 grand, you could be at 100, you could be at 200 grand. All of a sudden that average price is much better. And that gap between the market doing what it's doing on screen is in your favor. And that's what we call dollar cost averaging. So all of that flat line, all of that issue, COVID's a great example, that big sharp decline. If you had bought it at the bottom of that, you were buying at the same price of that in 2016. And then look at what's happened to it. So it also gives you a strategy. And this is what I do. I'm a strategist, right? If you can think about it from the point of view that my strategy is just to keep slowly but surely adding to it, my average price is going to get better and better and better and better and better and better. And therefore my compounding is going to get better and better and better. My exposure is going to get better and better. The dividends are going to get bigger. My total return is going to get bigger.
Interesting one for you, Effie. Your
Long-winded,
opinion on the 4% rule of retirement. Have you heard of that one before? I'm assuming it's around that FIRE movement.
It's the 4% rule. Are they talking about
capital at 24 times to produce a return on investment, 4% to replace an income potentially? Is what they're alluding to there.
The 4% rule of drawing down your super, how much you can actually draw down with super? Is that what they're saying?
I have a feeling it's about building enough capital to produce a 4% conservative 4% return to replace an income stream, basically.
Oh.
Have you heard of that one before?
No, I haven't. Actually, I've heard the 4% drawdown on super.
yeah, sure. And because I remember talking to you about the FIRE, the financial independence retire early movement, right? Yeah. So I'm assuming that's what Juan is talking about here.
Right. No, I wouldn't be able to comment too much on that one.
Thoughts on crypto? There's a question on.
I've been waiting for this.
In Bitcoin? What other cryptos would you invest in? And okay. Are you invested in crypto?
First and foremost, no. And disclaimer is, crypto to me, the technology is fascinating. I think it's a really beautiful thing, blockchain. I think for someone like me who's worked in markets for long, to call it a currency just annoys the living bejesus out of me. And the reason for this is that we've talked about inflation a bit tonight. How can you transact with a tool that can inflate and deflate prices in a day, which is what we, in fiat currency, which is what your Australian dollars or your US dollars is, it's flatlining that problem. So how can you transact? Anyway, that's a different point. The other thing is that they're all very, very, very different. So everyone knows about Bitcoin. Bitcoin is the one that probably is actually giving crypto the bad name, because the structure of Bitcoin can be argued, and again, you can come at me for this, as a Ponzi scheme. But if you look at an Ethereum, for example, Ethereum as a product and the way that it is structured is probably the way forward for cryptos. I'm not going to say the word currency in terms of what it does. So if I had a choice, I'd choose Ethereum over Bitcoin because the system is much better and it's growing in a way that should be. But Bitcoin gets the headlines because, yeah, you can all of a sudden make, like we saw this year, $60,000 a coin. It can also, and therefore be up 3,500%, as some people keep telling me. If you managed to invest in 2009 when this thing started, awesome. But you didn't. Most people didn't. And I can promise you, most people have experienced the 2011 pullback, the 2013 pullback, and are now experiencing the 2021 pullback and watching their money go.
And please do not get debt to acquire crypto. Whatever
yes.
Do not do that. That is very, very dangerous. Please don't do that. I've heard so many horror stories on that front.
So yes, you can see I'm not a massive crypto fan. And I get absolutely smashed on Twitter about it. I don't care. I love it.
Yeah, I share much the same sentiment. And unfortunately, people do. It's always kind of, trying to
get rich now.
Yeah, jump in when it's already gone. And I think you really need to understand what you're investing in. It's interesting to see that I'm seeing a lot more investment platforms putting it in as part of their asset mix. So I guess if you want it as part of your portfolio, then maybe look into some of those. But yeah, I can completely agree, Evan. I would, me personally, stay clear.
So let's just finish off on that. I'll be a bit more balanced. If you're going to do it, by all means, I understand it. But this is when we come back to mix, right? It should not be the only investment you have. In fact, it shouldn't even be 50% of the investment you have. In our world, what Effie, Andrew, and I do, at the most, we would say it's 5% of your portfolio. Probably more likely 2.
Yeah, that's where I was heading. Thanks, Evan.
Sorry, bud.
Great that you brought that forward, guys. You certainly don't want to be going all in on these things because, like the poof sound that Evan mentioned earlier, it happens all the time. Please be extra careful with this thing. It's highly volatile. Yeah, Ethereum is something to.
It won't let you sleep. And look, I understand the old adage of if you can sleep at night, your position's not large enough. That's for traders. That's for gambling. You need to sleep, and therefore. If you can't sleep because you've been exposed to crypto, I'd probably say that's your answer.
Cool. So I think one last thought before we wrap this thing up, Effie. Thank you very much for your time once again, Effie and Evan. We really appreciate it. One last thought to leave the audience so that they can get on their merry way and start investing.
Effie, you can go first. I think you should sign off on that comment.
Oh, gee, for me to start investing, get educated. Understand that everybody is a salesperson out there, so take care. You really do. You need to educate yourself. And don't be afraid to get help, but the education should help steer you to a certain extent. And for me, it's fear of jumping in can be just as bad as fear of missing out. Mm-hmm. And it is take action. And my biggest thing is save small, save often. Just do it. Get in and do it. And always jump into what you understand. Pretty simple.
So I was going to say something similar. What I was going to say is the thing I've learned more than anything, reach out. So obviously Effie said, contact. The hardest thing in human nature is to actually ask for help. The hardest thing in human nature is to talk to other people. So the only, in my view, beautiful thing that social media has done is that you don't have to do this. You can type to people, and that is reaching out. So that when you reach out to an Effie, when you reach out to an Andrew, they will come back to you. They're the kinds of people that will do that, and that will help your journey because all of a sudden, these are the kind of people that will actually genuinely want to talk to you because they are passionate about investing, they are passionate about education. And that is what I've learned is that to start, if you are wondering about how you start, reach out because they will then point you and educate you. They'll point you to education. They'll help you through how to start. They will help you how to actually get involved, to actually not make the mistakes that they've made. Because we're all human. And as you've heard, we've all made the mistakes. And just because we do this doesn't mean we're gurus at it. We all make mistakes. So the biggest takeout I've learned over the last 20 years I've been doing this, reach out.
And also the old key for me is what I find is people compare themselves.
Yeah.
it's called personal finance for a reason. It's personal. I am a journalist on a journalist salary. It's a good salary. I'm not crying poor, but I make the best of what I do. And this is the best of what I can do. And don't get bogged down about, you see so much in the media that this person has 50 properties or this person made X amount and so on. You're on your own personal journey, and it's all about making the most of what you earn. And the key thing is, and it comes down to this saying, it's not what you earn that counts, it's what you spend. And I think I shared this with you, Andrew, that quote. It actually, Paul Clitheroe gave me that when I went and got my job from him. And it was a really funny story behind that, in the sense that, you know, earning a good income, going to see him, and he goes, Effie, I'm going to share you one of the best tips I've got. And it was that. And he said, it's for that reason I'm going to give you this job at half the salary. And I took it. Because it's not what you earn that counts, it's what you spend. And I guess that's the most important thing.
I think that's we're going to cap the night off with that. That's amazing. Thank you very much once again. I keep saying thank you, but I can't help myself. Really, really appreciate you coming along to these webinars, Effie and Evan. Thanks very much.
Guys, thanks for having us.
Dropping by. I'm sure we will have you back. It's been excellent to spend some time with you all. Hopefully, the attendees got massive amounts of value, wrote a ton of notes, and we very much look forward to seeing you all in the next Get Finance Fit webinar series talking about acquiring your first property.
Thanks, guys. Have a good night.
Thanks. Bye.